At the time of retirement of a partner, the retiring partner is entitled to get the following benefits from the firm, following aspects from the firm. One is credit balance of his capital. Credit balance of his capital. Just generally, the capital balances are of credit side. So if is there any balance, he is entitled to get it back at the time of retirement. And credit balance of his current account, if any, and share of goodwill. Yes. If the partner, if is there any goodwill in the firm, he has the right to share in it. For example, some goodwill is existed in the firm. Now the partner is retiring, and additional goodwill is to be created. So already created, in the already created goodwill, partner's share is already divided, already distributed. But the new goodwill, he has the share. The additional, if the additional goodwill is created, that in that the new partner has the share. So that should be distributed and credited to his capital account. Share of reserves or undistributed profits. Yes. For example, if there is a general reserve, that should be distributed to the partners, all partners, including retired one. Or profit and loss account at the liability side, that is undistributed profit. Profit and loss account at the liabilities side. If it is shown in the at the liabilities side, that is the undistributed profit. That should be that the new not new partner, the retiring partner has the right to get share in it. So that should be distributed. It's a share in the profit valuation of assets and liabilities. Generally, the retiring one has the right to share in the profits of revaluation of assets and liabilities. He must be given the profit, either profit or loss, due to the revaluation of assets and liabilities. Sometimes it may be loss, sometimes it may be profit. Whatever the thing it may be, but should be distributed to the all partners. And share in profits up to date of retirement. Sometimes the retiring partner may be retired at the middle of the financial year. So he has the right to share, to get the share in the profits up to the date of retirement. up to the date of retirement. So share in profits up to the date of retirement or death. Interest on capital if involved. Sometimes in the partnership deed, it is mentioned that some interest must be paid to the capitals. Some may bring huge amount, some may bring a little amount. So the partners who bring the huge amounts will be benefited with this interest. So if is there any such kind of provision or term in the partnership deed, the partner is entitled to get the interest on capital. Okay, and salary. In partnership firms, some partners are active partners and some others are passive partners. Some are sleeping partners, some are nominal partners. So the salary is given to the partners based on their performance or work to the firm, rendered to the firm. So based on the rendering of the services to the firm, the salary is fixed. So that salary which is fixed in the deed, which is mentioned in the deed, should be paid to the partner who has such kind of right. So all these items are added to the capital accounts, that is at the credit side of the capital accounts, and shall see deductions from the capital accounts. Deductions from the capital accounts. Yes. Debit balance of his current account. If is there any debit balance, that should be deducted from the capital account. Share of goodwill to be written off. Yes. If the goodwill is written off, that much should be entered in the capital accounts at the debit side because it is written off. So it reduces the balance of the capital account. It reduces the balance of the capital account. And share of accumulated losses. Sometimes we see profit and loss account at the assets side. We see sometimes profit and loss account at the assets side. It indicates that that is the loss and that is not distributed to the partners. Loss is not distributed. So at the time of retirement of a partner, is there any such kind of items? That is the profit and loss account at the asset side. That should be distributed. That loss should be distributed among the partners. So we must have an idea that at the assets side, if it is seen the profit and loss account, that is the loss. Is it okay? Okay. share of accumulated loss, that is profit and loss account, or any other losses. Now drawings and interest on drawings. Yes. If you have drawn any amount from the farm, that should be debited. That should be noted at the debit side of the capital accounts. So it causes for the minimizing the balance. And interest on drawings. Sometimes there may be the term that the interest should be calculated on the drawings of the partners. In such situations, the interest also should be calculated. That two causes to the reducing the balance of the capital accounts. These two are the reducing aspects of the capitals. Yes, if any loss is occurred due to the revaluation of the assets and liabilities, generally at the time of retirement, profit and loss appropriation or a revaluation account is prepared, assets and liabilities are revalued. With that, if any loss is arrived, that loss should be distributed, and that causes the reducing the balance of the capitals. And the sixth one is his share of business loss. Yes. For example, at the time of retirement, if the firm is sometimes incurred the losses, if it has got the loss, up to that date, that business loss should be entered at the debit side of the capital accounts of that retiring partner. So, see once again, the balances which are credited of the capital accounts are, see, credit balance of current account, share of goodwill, share of reserves and undistributed profits, profit of revaluation account, profits up to date of retirement, interest on capital, salary if any. And the reducing aspects are debit balance of current account, share of goodwill to be written off, share of accumulated loss, drawings and interest on drawings if any, share of loss on account of revaluation of assets and liabilities, share of business loss up to the date of retirement if any business loss. So at the time of retirement, all these items are taken into consideration. Yes, with in this class, we shall see another problem on retirement of partner. I shall read the problem carefully. Now I read the problem carefully. Listen. Sanil, Nitish, Swapna were partners in a firm, sharing profits and losses in the proportion of 1/2, 1/3, and 1/6 respectively. Their balance sheet as on 31st March 2012 was as follows. Liabilities. Bills payable 30,000. Capitals Sanil 80,000. Nitish 50,000. Sapna 30,000. Total 1,90,000. And at the assets side, machinery 40,000, furniture 5,000, sundry assets 60,000, stock 30,000, debtors 32,000, bank 23,000, total 1,90,000. The last partner, Sapna, decided to retire on 1st April 2012 on the following terms. Goodwill of the firm will be valued at rupees 30,000. Furniture was taken over by Sanil for rupees 4,700. Make a provision for unpaid expenses rupees 1,700. Out of the amount due to Sapna, rupees 7,500 to be paid by check, and the remaining amount to be transferred to her loan account. Okay, so this is the problem. We have to prepare the profit and loss adjustment account, capital accounts, balance sheet. Before going to the problem, shall see the adjustments once again. Goodwill. In the balance sheet, there is no goodwill. See, at the asset side, there is no goodwill. But now the goodwill is to be created, an amount of rupees 30,000. This is pertained to all the partners, including retiring partner. Goodwill is earned by all the partners. So 30,000. The retiring partner has the right to share in it. Furniture was taken over by Sunil for rupees 4,700. And unpaid expenses liability is raised, so we should make a provision for it, and for an amount of rupees 1,700. Out of the amount due to Sapna, rupees 7,500 to be paid by check, and the remaining amount to be transferred to her loan account. So, after making all the adjustments, the amount due to Sapna is to be paid of rupees 7,500 immediately by check, and the remaining part, the remaining amount to be transferred to her loan account. So this is the problem. First we prepare the profit and loss adjustment account. Yes, we know that while preparing the profit and loss adjustment account, we must have an idea that if the assets are decreased and if the liabilities are increased, they should be recorded at the debit side of the profit and loss adjustment account, and at the credit side vice versa. That is, if the assets are increased or if the liabilities are decreased, they should be written at the credit side of the profit and loss adjustment account. And the credit balance of profit and loss adjustment account is considered as profit, and the debit balance is considered as loss, and this should be transferred to the capital accounts of all the partners, that is including the retiring partner. Yes. Now we shall see. So furniture, see, the furniture was taken over by Sunil for 4,700. Yes. Is it any change in it? See, any change in it? The furniture actual price is 5,000 and it was taken for 4,700 by Sunil. So there is 300 variation. This is the depreciation. This is decreased. This is decreased. So this should be mentioned at the debit side of the profit and loss adjustment account, because this is 5,000. This furniture is taken over by one of the partner, and this value is less if we compared with the book value. So there is a depreciation. That is 300 is a depreciation, that is decreased. It is mentioned. And the second point is make a provision for unpaid expenses of 1,700. 1,700. See, this is the liability. This is the liability. Some expenses are not paid earlier. It is arisen to pay for an amount of rupees 1,700. That is provision for unpaid expenses. 1,700. So the liability is increased. This is asset is decreased and this is liability is increased. This asset is decreased. So 1,700 total amount should be written in the profit and loss adjustment account or revaluation account. Okay. Now shall move further. Out of amount due to yes, this is okay. This should be the fourth adjustment should be written at the time of preparing the capital accounts of the partners. Yes. Now shall see the revaluation account, that is a profit and loss appropriation account. So in this, is there any asset is, observe carefully, is there any asset is increased? Watch this. Is there any asset is increased? If it is increased, that should be noted, that should be recorded at the credit side. See carefully. So no asset is increased, no liability is decreased. So it has the debit balance of 2,000. That 2,000 should be distributed among the partners. See, Sanil's capital, Nitish capital, and Sapna's capital. As for the ratio which is given at the beginning of the problem. Okay. So now shall go for the preparation of capital accounts. Balances, starting balances 80,000, 50,000, 30,000, which is given in the balance sheet. See, 80,000, 50,000, 30,000. So 80,000, see, this is see, Sanil 80,000, Nitish 50,000, Swapna 30,000. These are the balances, capital balances given in the balance sheet, starting balance sheet. So these should be entered at the credit side of capital accounts. Okay. Now see here, these are mentioned here, capital accounts 80,000, 50,000, 30,000. Okay, so this is what this is what see this profit and loss adjustment account. This is loss. So loss should be written at the debit side of capital accounts. So partners capital accounts debtor to profit and loss adjustment account. So Sanil capital account debtor to profit and loss account. Nitish capital account debtor to profit and loss account. Sapna capital account debtor to profit and loss adjustment account. So this is the loss which is arrived in the profit and loss adjustment account. This is the loss which is arrived in the profit and loss adjustment account. This is the loss. If it is it is got the profit, that should be mentioned at the credit side. Is it clear? Yes. Now see, these are the balances, and this is the profit. Now this is the loss. Now furniture 4,700 is taken over by Sunny. Furniture is taken over by Sunny. So journal entry is Sunil capital account debtor to furniture account. So Sunil capital account debtor to furniture account. So Sunil account debtor to furniture account 4,700. So here the furniture is taken over by Sunil and deducting this much amount in his capital, 4,700 in his capital. Not in the way of cash, but by deducting in the capital accounts, by reducing the balances in the capital account. Yes. Now see, this is bank account. This is what, no, this, yes, you put aside for some time this one, and this is the goodwill. Goodwill is how much? Goodwill is 30,000. Goodwill is 30,000. So we have to make the entries, see, like this. Shall see. Yes. Goodwill is 30,000. So among the 30,000, the ratios are, see, 30,000. First one is Sanil, the 30,000 into 1 by 2 is equal to 15,000. Okay. Again 30,000 into 1 by 3, that is equal to 10,000. Again 30,000 into 1 by 6 is equal to 5,000. Goodwill, see carefully. Total goodwill is 30,000. That should be distributed among the partners. First partner has the share of 1 by 2, that is 30,000 into 1 by 2, 15,000. Second partner, 1 by 3, 30,000 into 1 by 3 is equal to 10,000. Again 30,000 into 1 by 6, last partner. So his share is 1 by 6, the goodwill is 5,000. Okay, now, yes, now we have to close the capital accounts. Before going to close the capital accounts, we have to pay an amount of rupees 7,500, and remaining balance should be transferred to loan account. An adjustment is given here. See carefully. This is the adjustment. See, out of the amount due to Sapna, rupees 7,500 to be paid by check, and the remaining amount to be transferred to her loan account. So first we have to pay 7,500 by the way of check, and the remaining amount to be transferred to her loan account. Okay, so now we shall see the balance. Yes, in the capital accounts. See this is the Sanil's capital balance is 95,000. 95,000. In this 95,000, first, no. The retiring partner is Sapna. So Sapna balance is 35,000. Sapna balance is 35,000. In this 35,000, first we have to pay 7,500 in the by issuing a check. By issuing a check, 7,500 we have to pay. The remaining balance is this. The remaining balance is 27,167. This should be transferred to loan account. Sapna's loan account. So balance is 27,167. So we have paid 7,500 through check, and remaining balance is transferred to her loan account, Sapna's loan account. Okay, so now the balances are already this 4,700 furniture is taken over by this Sanil, and the balance is 8,933. So in the new balance sheet, capitals are these two are the capitals, and this is the loan account. So these are the capitals of the existing partners. Now we shall see it. Okay, capital account. Now balance sheet as on 1st April 2012 of Sanil, Nitish after Sapna's retirement. after Swapna's retirement. This is the balance sheet. Okay, so now we shall see bills payable. Bills payable. Yes. Is there any change in this bills payable? No change. And Sunil Capital, already just now we have seen 89,300. 89,300. Yes. And Nitish Capital 59,333. This is capital. Okay. Now loan account of Sapna 27,000. See, this is 167 is the loan account of Sapna. And what about this? Provision for unpaid expenses is made in the profit and loss account, adjustment account, and it was not recorded, so now it is being recorded in our books. A new liability is arisen 1,700. Okay, so this is the debits, not debit, but the liability side of balance sheet. Now we shall see this machinery. Is there any change? No change. 40,000. Sundry assets, no change. Stock, also no change. Debtors, no change. Bank, yes, here is a change. Earlier the balance was in the balance sheet. See this. Yes. See this, the cash bank balance is 23,000. 23,000 bank balance is. So now this balance is reduced by 7,500 because from this 23,000 we have issued a check of rupees 7,500 to the retired partner. We have paid an amount of rupees 7,500 through a check. So that should be subtracted from this 23,000 and the balance is 15,500. See carefully. Is there any goodwill at the beginning balance sheet? Lost item, please see. Goodwill 30,000. Was there any goodwill at the beginning of the balance sheet? At the starting balance sheet, there was no goodwill. Now goodwill is created and it is distributed among the partners. So it is in the capital accounts of the partners and at the assets side. So now goodwill is recorded. So one asset is missed. Please check. One asset is missed. Please check. So you have to find out the asset which is missed in it. So that is furniture is taken over by one of the partner. So the furniture is not mentioned here. Okay.